Two people, same year, January 2015, same amount of money, $100,000 each. Person A puts it into Bitcoin. At $314 per coin, that is 318 Bitcoin. Person B uses it as a down payment on a house in Phoenix, Arizona. Both start January 2015. Both end today, May 2026. 11 years. Let us see what actually happened. My name is Donald Cash. Double chin, gold tie. Jerome, who is currently sitting in a sunbeam in a manner that suggests he has no interest in return on investment calculations and is doing fine. Today, the most specific version of the Bitcoin versus real estate question I can give you. Same $100,000, same starting date, completely different paths, every real number, every cost, every tax, every psychological test. Before I run the numbers, I want to be clear about the setup. $100,000 as a 20% down payment means a $500,000 property. In Phoenix, in January 2015, that was an upper-tier home. The median was around $225,000. A $500,000 house was a good home, not a mansion. Comfortable, well-located, representative of what someone with this kind of capital would realistically buy as an investment property. This is not a cherry-picked comparison. This is a fair one. Let us go. The Phoenix property, January 2015. Purchase price, $500,000. Down payment, $100,000. 20%. Mortgage, $400,000. 30-year fixed at 3.7%. That was the going rate in early 2015. Monthly principal and interest, approximately $1,844. The house rents for approximately $2,400 per month at that price point in 2015 Phoenix. Market rent for a quality upper-tier property. On paper, before real expenses, positive $556 per month. Now, let me add what most comparison videos leave out. Property tax in Maricopa County. Effective rate approximately 0.6 to 0.7% on assessed value. Roughly $3,000 per year, $250 per month. Landlord insurance. Approximately $2,000 per year, $167 per month. Maintenance and repairs. Industry standard 1% of property value annually, $5,000 per year, $417 per month. This is the baseline. It does not include the roof replacement. It does not include the HVAC that dies in August. It does not include the water heater at midnight. Property management at 8% of monthly rent, $192 per month. Vacancy allowance at 5% of annual rent, $120 per month. Total real monthly outflow, mortgage $1,844, plus expenses $1,146. Total $2,990. Monthly income $2,400. Real monthly cash flow in year 1, negative $590. Per year, negative $7,080. Now, before you stop the video, the mortgage payment is not purely a cost. In year 1 of this mortgage, approximately $9,000 goes to principal paydown, building equity that belongs to you. And here is what happened to Phoenix over 11 years. Phoenix was one of the best performing major real estate markets in the United States. From 2015 to 2022, the population grew from roughly 4 million to approaching 5 million. Jobs grew. Remote workers arrived. Sunbelt migration accelerated during COVID. By mid-2022, Phoenix home prices had surged to a peak of approximately 85 to 90% above their 2015 levels. Your $500,000 property was worth approximately $930,000 to $950,000 at the peak. Then the correction. Rising mortgage rates, affordability pressure, market normalization. By March 2026, the Phoenix median sale price was $460,000, down 5.2% from the prior year. For the upper-tier property purchased in 2015, current estimated value approximately $720,000 to $750,000. The pandemic gains were real. The correction brought some of them back. Most of the appreciation held. Let us use $735,000 as our current value. Your mortgage balance after 11 years, approximately $334,000. Equity, approximately $401,000. Now, what did this actually cost to capture? Down payment, $100,000. Cash flow over 11 years. The negative $590 per month in year 1 improved as Phoenix rents surged by 2021 and 2022. Comparable Phoenix rents were $3,500 to $4,000 per month. Your fixed mortgage payment never changed. By year 6 or 7, the property was generating genuine positive cash flow of $300 to $700 per month above all expenses. Conservative net estimate of total out-of-pocket above the down payment over 11 years, accounting for negative early years and eventual positive cash flow. Approximately $60,000 to $70,000 net additional capital contributed. Total invested, approximately $160,000 to $170,000. After-tax equity on sale, accounting for capital gains at 15% to 20% federal, state taxes, and depreciation recapture at 25%. Estimated net after-tax proceeds above total invested capital, approximately $215,000 to $250,000, plus the tax benefits along the way, annual depreciation deduction, mortgage interest deduction, real dollar-for-dollar reductions in your tax bill every year you owned. Not extraordinary, but real, substantial, and built by default while you lived your life. Now, the Bitcoin path. January 2015. Bitcoin. $314 per coin. $100,000 buys 318.5 Bitcoin. You hold? What actually happened over the next 11 years? 2017, Bitcoin reaches approximately $20,000. Your position is worth approximately $6,370,000. 2018, Bitcoin crashes to approximately $3,200. Your position is now worth approximately $1,018,000. You lost $5,350,000 in 1 year. I want to stay on that number for a moment. $5,350,000. Gone. From your screen in 12 months. 2019 through 2020. Gradual recovery. By late 2020, Bitcoin breaks its 2017 high. 2021. Bitcoin reaches $68,789 in November. Your position is worth approximately $21,866,000. 2022. Bitcoin crashes to approximately $15,479. Your position is now worth approximately $4,928,000. You lost $16,938,000 in 1 year. 2023. Recovery begins. Bitcoin ends the year at approximately 42,000. 2024. Spot Bitcoin ETFs approved in January, fourth halving in April. Bitcoin crosses $100,000 for the first time in December. 2025. Institutional adoption accelerates. Bitcoin reaches its current all-time high of approximately $126,000 in October 2025. Then, the 2026 correction, Bitcoin fell from approximately $126,000 to approximately $60,000 in February 2026, a 53% decline from the October 2025 peak. In February 2026, your position of 318 Bitcoin was worth approximately $19,080,000. Then it became approximately $19,080,000. Actually, let me recalculate. At $126,000, approximately $40,107,000. At $60,000 in February 2026, approximately $19,080,000. You lost $21 million in 4 months. Today, May 2026. Bitcoin, approximately $80,800. Your 318 Bitcoin, approximately $25,694,000. After federal capital gains taxes at 20% on the gain, approximately $20,545,000. $20,545,000 from 100,000 in 11 years. So, Bitcoin won by a margin that makes the real estate comparison look almost irrelevant. Case closed. Video over. Except, I want to ask you something, and I want you to be genuinely honest with yourself before you answer. It is December 2018. You started with $100,000 in January 2015. By December 2017, your screen showed $6,370,000. $6 million. Then, in 12 months, it became $1,018,000. You lost $5,350,000. Are you holding? Think about your actual life in December 2018. You have a mortgage. You have kids in school. You have aging parents. You have a car payment, medical bills, a life that costs money every month, and you are watching $5 million disappear. 5 months later, in April 2019, Bitcoin is at $5,000. Your $6 million has become $1.6 million, still down 75% from the peak. Are you still holding? Then 2021, you held. You are at $21 million. 2022, 16 million disappears in 12 months. You are at 4,900,000. Are you holding this time? Then 2025, October, $40 million on your screen. Then February 2026, 19 million. You lost 21 million in 4 months. Are you holding? I am asking because the $20 million after-tax return belongs exclusively to the person who made the correct decision at every one of these moments. The data shows what happened to the price. It does not show what percentage of the 318 Bitcoin purchased in January 2015 was still held intact in May 2026. Academic research consistently finds that most retail Bitcoin purchased near major peaks was sold during the subsequent crash. Most of it. Not a fraction of it. Most. The real return captured by the average person who bought Bitcoin in 2015 and sold at any of those crash bottoms, a fraction of the theoretical maximum, somewhere between a few times their money and zero. Not 20 million. The theoretical return and the achievable return are entirely different numbers, and the gap between them is filled with panicked decisions made at 3 a.m. looking at a phone screen. Here is the comparison that actually tells you something useful. The Phoenix property buyer experienced volatility they could not easily react to. You cannot check the price of your house every hour. There is no app refreshing your home value in real time. Your home is not liquid. If you panic and want to sell in December 2018, the process takes 3 to 6 months. Involves a real estate agent, closing costs of 5 to 8%, and involves either leaving your family without a home or disrupting your tenant arrangement. The illiquidity of real estate, that is often cited as a disadvantage, is one of the most powerful behavioral advantages it offers. The Phoenix real estate investor made one major decision, January 2015, when they bought. After that, the asset was sticky, locked in. The holding happened by default. The Bitcoin investor faced hundreds of decision moments across 11 years. Every price update, every news cycle, every conversation at dinner when someone asked what happened to the 100,000. Each of those moments was an opportunity to make the wrong decision. The Phoenix investor essentially had that option removed. Now, the income dimension. Because, for this audience, it matters. The Phoenix property paid income during the hold, eventually positive cash flow, monthly cash arriving in a bank account from rent by 2021 and 2022. The property was generating approximately $300 to $700 per month, above all expenses, on a fixed mortgage that never changed, while Phoenix rents rose 40%. Bitcoin generated zero income in 11 years. Not $1, not 1 cent. To access any value from Bitcoin, you have to sell some of it, which means every time you paid a car repair or a medical bill from Bitcoin, your position shrank. And every share of your position you sold was not there to benefit from the subsequent recovery. The real estate investor received income without reducing their position. The Bitcoin investor had to choose between living their life and maintaining their full position. One of these is harder to execute over 11 years than the other. Here is my honest summary. If you bought $100,000 in Bitcoin in January 2015 and held every single coin through 5 crashes each, larger than 50% through 11 years of news cycles and family dinners and moments of genuine panic, you have approximately $20,500,000 after federal capital gains taxes today. That is not a real estate comparison. That is a different category of wealth. If you bought a $500,000 Phoenix property in January 2015 with $100,000 down and managed it through 11 years of tenants and maintenance and negative early cash flow and eventual positive cash flow, you have approximately $215,000 to $250,000 in after-tax profit above total invested capital, plus some monthly income in later years. That is a real outcome, achievable, and captured by a large percentage of the people who attempted it. The theoretical gap between these outcomes is enormous. The realistic gap, accounting for actual human behavior under pressure across 11 years, is much smaller. Because most people who bought Bitcoin in 2015 did not hold all of it to May 2026. The crashes were too large. The temptations were too frequent. The life expenses were too real. And most people who bought Phoenix real estate in 2015 did hold it because they had no practical alternative. What does this mean for you in May 2026? Bitcoin is currently at approximately $80,800, down from the October 2025 all-time high of $126,000, up from the February 2026 low of approximately $60,000. It is in a consolidation phase. The correction from the 2025 peak was approximately 53%. Historical pattern. This is where long-term holders hold, short-term holders have already sold, and the next accumulation cycle begins. Phoenix real estate is in a normalization phase, down 5.2% from last year. Inventory is higher. Buyers have more negotiating room than in the pandemic years. Neither of these markets is in crisis. Both are in a recalibration after extraordinary runs. For someone building wealth in 2026, the answer is the same it has always been. A modest Bitcoin allocation, 5 to 10% of investable assets, captures the asymmetric upside, without requiring your financial survival to depend on your ability to hold through events like February 2026. Real estate, or REITs for the income engine, and the leverage benefit. Bitcoin as the asymmetric bet at the edge of the portfolio. Position sizing is not a minor detail. It is the entire difference between benefiting from Bitcoin's extraordinary return profile and being the person who sold at the bottom of the 2022 crash or the February 2026 correction. Jerome has completed his Sunbeam session and moved to Plan B, which is sitting directly on my laptop keyboard. I have moved Jerome. Jerome has returned to the keyboard. This is not a productive dynamic, and yet here we are. My tie is still tight. And the portfolio is still working. Let the money do the work. In the comments, if you had $100,000 in January 2015, which path would you have actually taken? Not which one looks better in retrospect, which one you would have actually chosen given what you knew then, and whether you would have held through December 2018. I reply to every comment. Donald Cash, out.